Hello traders, and welcome to a new day trading strategy video of mine. In today's video, we're going to be looking at 7 types of orders and how we can identify them and also use them in our own trading. So before we go into order types, I do want to announce that I have finally added crypto payments for the Fibonacci Master Guide. I've received many emails of traders asking me to pay for the Master Guide in crypto, and now on my website, you can pay with these 4 cryptocurrencies. I've also added a 20% discount if you choose to pay in crypto instead of paying in USD. So if you want to check that out, just feel free to click on the link in the description below. All right, so let's talk first about the 3 basic order types, and then we're going to be looking at the 4 more advanced types of market orders, of exchange orders that we can use. So if you already know these 3 order types, I'd recommend you click on the timestamp that is popping up now, because this is just going to be a basic overview of the 3 order types. So a limit order is where we pick the price that we want to buy or sell at. So if I want to buy at 7,000, what I can do is put a limit buy order at 7,000. And let's say that it fills and I want to sell. I want to take profit. What I can then do is place a limit sell order at 8,000, and if price trades up to 8,000, then my limit sell order will fill. What we can also do is not just pick the price that we want to buy or sell at, but we can pick the time that we want to buy or sell at. And the way we do that is by using a market order. So when I use a market order to buy, what I'm doing is I'm allocating an amount of capital and I hit market buy. What that does is buys at the best possible ask prices on the order book. So if I hit market buy on this example right here with an amount of USD Tether, and let's say I wanted to do, buy 1 Bitcoin, then if I hit buy 1 Bitcoin, what that's going to do is that's going to transact here at the best possible ask prices. Now let's say that I wanted to sell my Bitcoin. So I would want to sell my, my 1 Bitcoin here. What that's going to do if I click this is going to sell at the best possible bid prices. And it's going to sell all the way down until I fill 100% of the order that I selected. Now, what I can also do is place a stop order. And this can be very helpful for limiting your losses and also for trading into breakouts. So imagine that I want to pick the price that I want to market buy or sell. So if price goes below 7K, or let's say I buy at 7K and put a stop loss at 6,900. If price ever touches 6,900, then immediately a market sell order will execute and trade me out of my position. Now, the good thing about this is that if price just keeps going down, I'm able to buy more Bitcoin because I'm not just holding in my trade. I'm actually just getting out for small loss and then just buying back in, buying with more Bitcoin, and also being flexible and finding better opportunities for buying. What we can also do is a stop buy order, where let's say that price is trading at 7,000 and I put a stop buy order at 7,100. If price goes above 7,100, then immediately I'm going to market buy into the most, I'm going to be just market buying into the most, the lowest possible ask orders out here. All right, so now let's go into the advanced order types, the stop limit order. So we don't just have to use a stop and we don't just have to use a limit, but what we can do is use the stop limit order. And this can be really helpful when price bounces from one area to the other, and we don't want to just use a market order to just immediately get out of a position or get into one. The stop is just going to be the price that triggers a limit order, and the limit is just going to be a standard limit order. So to show dynamically just really what this means is, let's go to stop limit here. Now imagine that I want to have a stop loss. And let's say that if price goes below 68.70, I want to place a limit order to sell at 68.80. What this means is that if price ever touches 68.70, a limit order to sell is immediately going to pop up at 68.80. So I'm going to be trying to sell at 68.80. The good thing about this is that price typically bounces a lot from certain levels, as you can see here and here and here. The bad news about it is imagine that price goes to 68.70 and triggers my limit order to be placed at 68.80. If price just keeps going down, my limit sell order is just going to stay here. And I'm just going to stay in my position. So that's the bad news. The good news about it is that it allows you to trade that bounce. So when price goes down here and then bounces back, you sell here and then price goes lower. And you get to sell at 68.80 instead of selling at bad prices down here at any possible bid. You can sell here. We can also use this as a buy stop limit, not just a sell stop limit. So imagine that if price goes above, let's say 69.50, meaning that if price ever touches 69.50, I want to limit buy at 69.40. So imagine that I do this with $1,000 of capital and price hits 69.50 and then immediately recoils back to 69.40, then my limit buy order gets filled and price goes higher and I buy at a better price. So the stop limit order can be very helpful in really buying and selling at better prices than normally possible with just a stop loss or a stop buy order. Another reason to use it is that it's more disguised as an order. If I want to buy, let's say at 69.40, and I'm only going to buy at 69.40 if we go higher, this is a way we can actually disguise our order by, instead of just placing a large limit buy order like this, it's going to only pop up when a certain condition is met. That's a way you can slightly disguise an order, but there are better ways to disguise orders such as the hidden and the iceberg, and we'll be getting to that a little bit later. It limits your losses just like a stop loss would, and it can be used in breakout trading just as I had showed with the buy stop limit. All right, so now let's talk about the trailing stop. This type of order is typically going to be available for futures trading in some crypto exchanges, but I don't think many are going to allow this. You may have to use advanced software to use this as well, because some exchanges might not just allow you to do this one. So trailing stop is when we place a stop order that is placed a percent beyond the market price. So what this does is imagine that we buy at 97 and place a trailing sell stop at 2%. If price ever goes 2% below the current price, then our we will immediately market sell. So what this means is that if price goes up to 100, then our stop loss is immediately set at 98. So if price goes down to 98, we sell. And the good news about this is that we can really contain our profits. So if price just keeps going higher, then our trailing stop is just going to keep going higher linearly with price. And if price goes down to 98 and then continues to fall down to 95, we got out at 98 with a slight profit. But if instead of using a trailing sell stop, we just use a regular stop loss at, let's say, 95, what would happen is price would go up to 97 to 100, let's say high volatility, and then price just crashes down to 95. We would actually have a -2. We would lose money on this trade. Whereas if we use a trailing sell stop, we would just get out at 98 and we would actually make money on the trade, even though we had this kind of market reaction. So this could be a really good way to actually just continue to take profit on an uptrend and to prevent yourself from really going out of a profit. And the other benefit of this is even if price, like let's say, goes from 97 up to 98, we would have a sell stop limit a little bit above 95. So that we would actually have less of a loss than we would if we had a 2% stop loss at 97. We can also use this in the opposite sense of using a buy trailing stop. And what that would do is just, let's say that price just continues to go down, but we have a buy stop at 2%. If price ever goes up 2% at the current market price, then we will immediately market buy. So let's say price goes down here to 94 and then continues to go down to, let's say, 90. And then let's say that price goes immediately 2% upward, like this. But price was fluctuating before like this, but really not making a 2% jump at the current market price. We're not executing here. We're only executing when it goes 2% higher. And then we get our order filled, let's say at like, 94. And then hopefully, price just keeps going higher. So that's how the trailing buy stop works and also how the trailing sell stop works as well. All right, so now let's look at the two types of complex orders that are typically going to be only used by HFTs. The hidden order. The hidden limit order is an order that is not going to be visible in the order book. So if I want to buy a large amount of Bitcoin, but I don't want any other traders seeing my limit order being placed, then I can use this. So let's say I want to buy 100 Bitcoin at $1,000 per Bitcoin. I can place a hidden buy limit order at 1,000, and as price just continues to go down to my limit order price, I get filled, but no one else sees that I have a limit order at that price. All they see is many transactions occurring at 1,000. And this can be really good for large capital traders. The reason I say that is if you just place let's say price is trading at 1,000 and you place a limit buy order at 1,000, two things are probably going to happen. Either A, bidders' price is just going to continue to bid upward and you're not going to get your buy order filled because you're trying to buy so much that it forms a buy wall, a bid order wall. Or the second case that's much worse is, yeah, your order gets filled immediately, but then price just continues to go down. And the reason that happens is that if you place a limit buy order for 100 Bitcoin at a certain price, and then price just sells down immediately to your order and then continues to go a little bit lower, that's because there's probably heavy selling pressure that's probably just going to continue going down. So because of this is why we want to use a hidden order, to not allow other traders to outbid us and to not allow other traders to know where our bids and offers are, because this can also be used for limit sell order. It also disguises the strength. So we could be completely comfortable placing a 1 Bitcoin buy order at 1,000, but we probably don't want to show a 100 buy order. So that's why we want to use a hidden. And finally, the more sinister side of why we use hidden orders for HFTs is it targets other traders' stop losses. So if there are many traders placing stop losses right below support, we may not want to place a bid order, a live bid order at those stop losses, because what those traders who place those stop losses might do is put their stop losses just below our bid order, which is not good. That means that we're not going to get that liquidity from those stop losses that we want them to sell down to our bid order. But what they're going to do is cancel that stop loss, put it right below our bid, and then we're going to be the ones, getting sold down to, and then price is just going to go lower. But what you can do with a hidden order is, let's say you identify many stop losses in the current price zone. You can place a hidden limit buy order at that price zone so that when those stop losses trigger, they just sell down to your hidden order. And then those traders who place those stop losses there don't know, that order was placed. And unfortunately for them, but fortunately for us, price just bounces off and goes higher after those stop losses get hit. So this is really the way that hidden orders are going to be operating, targeting retail traders and trying to find points of liquidity where they can pick up many stop losses that are selling down to a bid that is not even visible. Now, this may sound great, but it's more common that iceberg orders are used. And an iceberg order is a hidden order where part of the order is going to be displayed throughout the order book. So back to our 100 Bitcoin being bought at $1,000. Let's say we are buying 100 Bitcoin at 1,000 with a hidden order, but we want to show 10 of that 100 Bitcoin. So we're actually stowing away 90 Bitcoin that's hidden and 10 Bitcoin that's visible, but our buy order is still at 100. Now, you may be wondering why traders would ever do this. The reason is it makes it actually harder to detect that there is a hidden order there. You can detect where hidden orders are, and there are actually other HFT bots that are made to detect where large hidden orders are. And they do two things. The first thing that they do is place micro orders that immediately test certain price levels. And what they're going to find is two things that may occur. If they find that they're repeated market orders, so if an HFT is, let's say, placing tiny market sell orders, and that market sell order continues to be executed at a certain price that's not listed on the order book, that's a hidden order, a hidden bid order. And once the HFT discovers that there's a hidden bid order, it can use that level to front run. So it can place a bid order, a new bid order of its own right above where it believes that hidden order is. And now that HFT just front run another hidden order. So that can be a complex way that HFTs can battle it out. But many traders would never even know this because they can't even see it happening. But I mean, it does happen, and that's why order book fluctuations can occur at sometimes. So with the iceberg order, what it does is with that bot that's trying to test out certain levels to try to find where those hidden orders are, kind of like a submarine looking for, mines, it actually can't, because if it continues to just sell with micro orders at, let's say, $1,000 per Bitcoin, we actually have a 10 Bitcoin buy wall right there. It's a little bit of a buy wall right there, where if you just continue to market sell, I mean, the HFT isn't going to know that that is a hidden order versus an iceberg order. It's just going to know that that's an order. The only way that the HFT would actually discover that that iceberg order at 1,000 is actually a hidden order is if it sells past that visible order. So let's say it sells past that 10 Bitcoin. It begins to tap into our 90 hidden buy wall. Then it would discover that there is a hidden buy wall there. But it would have to sell 10 Bitcoin off of that hidden order. Additionally, it's not only that institutions and HFTs are going to be using iceberg orders, they're going to be layering their iceberg orders. So they're not just going to be putting a singular hidden iceberg order at 1,000. They're going to be placing at a range. So let's say 1,000 to 1,020. They place a series of iceberg orders throughout those levels with about, let's say, 80% hidden, 20% visible. And that's going to completely disguise what they're doing in the market. And it's going to be very ideal for accumulating positions at that level. Same would go for the opposite if they want to distribute and sell. They could do limit sell orders for iceberg orders, like let's say at price goes up to 1,050. So from 1,050 to 1,060, it can layer iceberg orders throughout those levels. And an HFT bot that may find one hidden order at a certain level, well, we actually just layered many different kinds of hidden orders throughout many levels. So, well, great, you found one order that you can front run, but we have many other orders available too. So this is really how HFTs can use complex order types to beat other traders in the market and get best possible execution by using hidden orders and also iceberg orders for showing small amounts of capital so that other HFTs can't really find out that they're using a hidden order. And then also by layering the order book as well. So I know this probably went from like level 1 to level 100 order type very quickly, but it's iceberg orders and hidden orders that you're probably going to not be able to use unless you're trading futures or if you're trading with an HFT bot with custom algorithms. But it's really trailing stop, stop limit, and of course these basic order types that are going to be common on many exchanges and especially on futures exchanges as well. All right, so if you have any questions on complex orders such as the hidden order and the iceberg order, or are curious about a different kind of order that I may have not mentioned in this video, you can just leave a comment below or shoot me a message on Discord. But again, we have the 20% discount if you pay in crypto for the Fibonacci Master Guide if you want to check that out. And with that, happy trading.